Hey everyone, and welcome to chapter 14. Now, this chapter is going to be looking once again at the Federal Reserve, but this time look specifically at their balance sheet and the money supply process. And in this video, we're going to just go over what the balance sheet is for the Federal Reserve and then talk about the monetary base. And so we need to kind of pick apart our understanding of what money supply is. So for many of you, you must just think that the money supply is just the amount of currency that's available to the public, when that's actually only uh, partially true. So money supply is actually the monetary base, which is what you're thinking of as the sum of bank reserves and currency in circulation, but then we multiply it by what we call the money multiplier, and that's determined by the Federal Reserve, the banking system, and the non-bank public. And we're going to talk about how that can be the case later on. But when you multiply the monetary base and the money multiplier together, you get the ultimate definition of money supply. Now, let's look at the Federal Reserve's balance sheet. On the Federal Reserve's balance sheet, you have pretty much just any typical balance sheet, except for the fact that there's no shareholders' equity. So everything is an asset and a liability. And if you look, this is from in 2020, the Federal Reserve had total assets of nearly or of over $7 trillion, which means that it also had total liabilities in capital of $7 trillion. And when we look at the assets, they're broken down into a few different parts. You have securities, specifically U.S. Treasury, so this is T-bills and notes, and those account for about $4.1 trillion of the assets that the Federal Reserve has. Then you also have federal agency debt security, so that's the debt it is taking off the hands of other federal agencies. Those comprise of about $2 billion. Then mortgage-backed securities and other securities account for about 2 trillion of it, as well as repo agreements consisting about $79 billion. There's some other things that operate in here behind the scenes, but that's really the most interesting to me on the security side of things. Uh, then you look on the flip side what the liabilities are. One of the big ones, we consider any currency in circulation to be a liability. So there's $1.9 trillion at the time of this balance sheet snippet. There also are $3 trillion of reserve balances in banks, including term deposits. Those also go under the liability side for the Federal Reserve balance sheet. Then we have Treasury deposits as $1.5 trillion. So collectively, we're now getting really close to that $7 trillion number. You have a couple of secondary situations like reverse repos, the foreign government deposits, etc. But this isn't really who the Fed is dealing with the most. The most of it is really coming from these reserve balances of banks. Now, let's look at the balance sheet in a different lens. Instead of looking at one cross section, we're going to look at it over time. And you can see that it was pretty stable up until the financial crisis. And then you can really see when TARP was introduced, you had a huge surge in the balance sheet and assets, and then that just kind of slowly kind of declined or increased all the way up to about 2014 when finally the assets that the Federal Reserve held stabilized, went down a little bit, and then we have everything that happened with COVID-19. So this is all talking about when they purchased commercial paper, etc. That is how their assets bloomed so quickly in 2020. Now, let's now move on to the monetary base specifically. So let's go over a couple definitions. First, the currency in circulation is the paper money circulating outside the Federal Reserve. So the currency that the Fed is not controlling right now. Vault cash is currency held by banks. Currency in M1 is the currency in circulations minus vault cash. So this is the currency that is just being held by the non-bank public. Bank reserves are bank deposits with the Fed plus vault cash. So we're doing the opposite side. we're looking at what the bank is depositing with the Fed plus what they have in their vaults. And so we get the monetary base is currency in M1 plus total reserves of banks. So we can look at this a different way. The monetary base is all the cash that the general public, that all of us own at one time, plus we're looking at all the cash that is controlled by commercial banks. Now, the required reserve ratio is the percentage of checkable deposits that the Fed specifies banks must hold as excess reserves. So these total reserves can actually get broken up into required reserves and excess reserves. But right now, since we don't have any required reserve ratio, any reserves that banks are holding on to are considered excess reserves. Now, as a reminder, open market operations are the Federal Reserve's purchases and sales of securities. And Fed employees will buy and sell on their own trading desk only with primary dealers. So you couldn't just hop it on to Robinhood and sell a stock to the Federal Reserve. Now, there are 24 primary dealers right now, which comprise mostly of investment banks, but also security dealers and the securities departments of commercial banks. So, for example, we're looking at JP Morgan Chase, Goldman Sachs, Wells Fargo. So, all these large financial institutions that we've talked about through this class. Now, in an open market purchase, all that the Fed is doing is buying a security, now usually they're treasuries, and in doing so, they increase the monetary base. And so if you have like a US treasury that a bank is holding on to, because they want to get the interest from it, the Fed is going to replace that with cash. And in doing so, the reserves are going to go up that the bank has. And that, if you remember, increases the monetary base as part of the bank reserves. So how does this work? Well, let's go back to our T-chart. So let's first look at the Federal Reserve. They decide that they want to make an open market purchase of $1 million of treasury bills. What ends up happening is their assets increase by $1 million in securities, and then their liabilities increase by $1 million in reserves. On the banking side, they actually don't have any change in their liabilities. They're just trading a security for additional reserves. So that's why you have $1 million lost in treasuries and then $1 million gained in reserves, both on the asset side. And then let's look at what happens at this point. We're going to say that then somebody decides to withdraw $1 million from their funds, which is financed by this sale of treasuries to the Federal Reserve. Well, the bank's liability of checkable deposits is going to decrease by $1 million since the non-bank public is taking out $1 million in deposits. And then that also means that they have lost those $1 million in reserves. So their assets are now going to go down by $1 million as well. And now this is a very similar process for a discount loan, which increases the Fed reserves and assets by the loan amount. So now we're going to move on to comparing open market operations with discount loans. Discount loans are loaned out at what we call the discount rate, which is just the interest rate the Federal Reserve charges on discount loans. And these loans limit Fed market control because banks can decide whether or not to take out a discount loan. So they're different from open market operations because they don't have the same amount of control. And since there's a big difference between discount loans and open market operations, the monetary base is studied in two parts, where B, which is going to be important because we're going to refer to the monetary base as B throughout the rest of these slides, is equal to the non-borrowed monetary base plus the borrowed reserves. And in the context of this class, it's not super important to differentiate between them, but if you do further study in monetary policy, it's going to be important to separate between non-borrowed money and borrowed reserves, these discount loans, because these discount loans are quickly going to vanish from the market.